Hi everyone, and welcome to today's Insurance IoT webinar. It's our Insurtech investor briefing, and it's great to see that we have over 750 people signed up for this, so fantastic to see so many of you interested. My name is Marcia Irving. I'm Head of Innovation with Insurance Nexus. I've worked on putting this webinar together, and it's my pleasure to introduce some of the contributors of the webinar. So we have Dan Reed from American Family Ventures, Jacqueline Lesage Krause from Hartford Steam Boiler Ventures, Laura Kane from Tom Vest Ventures, Brian Hemasath from Global Insurance Accelerator, and Stephen Applebaum, who's our moderator of this. He's from Insurance Solutions Group. So welcome. And I just wanted to mention that we've decided to run this webinar in the run-up to our second annual Insurance IoT USA Summit. It's taking place on November 15th and 16th at the Hilton Magnificent Mile in Chicago. We're expecting 300 people there, so we're quite excited about this event, and it ties in extremely well and obviously quite naturally to the topic being discussed today here on the webinar. Just so you know, we've decided to offer a very special discount to everyone who signed up for the webinar. You can see that on your screen here now, and it's something that I will also share by way of email after the webinar, so keep an eye out for that. And we've got the URL for the event website there, so take a look. Next one. Joffrey, can you go? Sorry, we're just clicking on to the next slide. Perfect. Perfect. So basically, just to give you a little bit of background about who we are here at Insurance Nexus, if you haven't heard of us, we are part of FC Business Intelligence. Our insurance team here has been around for about 4 years, and we really aspire to be the central hub for insurance executives. We are day-to-day conducting in-depth research, analysis. We develop events. We produce content like this webinar, as well as white papers, surveys, infographics, etc. So please keep an eye out for the pieces that we do. We're really trying to help the community move along. And that's my contact details. That's me there if you're wondering who you're hearing from. Next slide, please. So just a few things that I wanted to point out before we move forward with the webinar. First of all, the recording. A lot of people have been saying that they're wondering about the recording and when that's going to come out. So the webinar recording is going to be sent out within 2 weeks of the broadcast. I will get that out to you as soon as I possibly can. During the webinar today, we're also launching a few interactive polls, so please pay attention when those are launched. We'd love to get some great results, so the more of you that take part, the better they're going to be. And then finally, if you send your live questions in, we have an interactive questions element to this at the end of the webinar. So please send your questions in. I'll be taking note of everything that's being sent through, and we'll try to get through as many of those questions today as we possibly can. Next slide. So now I'd like to get us started, we are going to be handing over to Stephen Applebaum. He's chairing the webinar today, and he's going to run us through a few slides at first and then introduce our fellow speakers. So Stephen, I hope we have you there.
Thanks, Marcia.
Perfect. I'll hand over.
Thanks, and very special thanks to our panelists today for their participation, and welcome to the more than 750 registered participants. It's obvious from the overwhelming response that Internet of Things technologies for insurance and related investment activity in this space is of significant interest. To set the stage for today's discussion, I'd like to share a few high-impact slides and graphics that together help illuminate the state of play in the area. This slide, put the slide up please, this slide from the Joint KPMG CB Insights report on the pulse of fintech illustrates that VC-backed Insurtech investments hit the billion-dollar mark across 47 deals completed in the first half of 2016, the majority of which were in U.S.-based startups. And this compares to $2.5 billion of investments in 74 deals for all of last year. Next slide, please. This graphic from the same KPMG CB Insights report shows that to date, during 2016, the largest Insurtech deals were in health, and that while New York-based deals had the highest total value, San Francisco had a higher number of deals. Next slide, please. This chart compliments of Tom Vest and Laura Kane, one of our panelists today, shares the insight that insurance has become a new hot area of investment by VCs after online lending set the stage for increased investor confidence in verticals featuring heavy regulation and high capital requirements. Next slide. I really think this is a brilliant graphic from our friends at Strategy Meets Action and St. Nick Media, which organizes Insurtech and IoT companies into logical categories and displays their relationships with one another. It also reveals that distribution disruptors lead with 30% of all categories, followed by the connected world at 18%, and a relatively even spread across the others, with claims ecosystems still just emerging at 9%, but an area which we predict will expand quickly. Next slide. This informative infographic from Venture Scanner organizes and provides company counts within even more finely defined categories. Notice the number in the center circled in red, stating that they have identified 923 such companies in the landscape, a number that may surprise many of us. Next slide. Once again, this chart from Venture Scanners provides a different relative view of Insurtech categories ranked by total funding across 535 companies, with health leading, auto insurance just behind, and on down to reinsurance. Next slide, please. Reinforcing the findings in the prior slide, this chart from Tom Vest identifies health and auto insurance, the two largest segments of insurance, as measured by overall premium income, as logically receiving the majority of early insurance investment funding. And one final slide to complete the picture. This graphic, again from Venture Scanner, presents Insurtech categories by level of innovation as measured by total number of companies in each category. Interestingly enough, it reveals that the comparison and marketplace category leads with 137 participants, followed by infrastructure and back-end, then auto, then health, and on down. With that background and context, let's move into our panel discussion. Next slide. And just before we get started and turn it over to the panel for questions and answers, I'd like to offer the first live polling question at this point. And here it is. So, telematics will be used in some aspect of what percentage of auto claims within 5 years. I think that was cut off, but it is within 5 years. So please select one. Will it be more than 1%, more than 5, more than 10, or more than 50%? We'll give you all a minute to vote. With so many people signed into our webinar, this is going to be a very valuable and interesting survey result. If we have our answer, we can put it up. So 49% believe that more than 10% of claims will employ some aspect of telematics within 5 years, and another 42% say even higher than that. So almost 90% plus talk about in excess of 10%. Very interesting. Thank you for doing that. Let's get started, and I'm going to start posing some questions to our panelists, and we'll go around in no particular order, with the first slide representing the question about identifying top technologies that are seeing investment interest in insurance, or in other words, what is being adopted first and what technologies have real potential. And if I may, I'd like to call upon Dan Reed first from American Family Ventures.
Thanks, Stephen, and thanks to everyone for listening in. So I think you covered it pretty well in terms of the technologies that are receiving investment. For us, the slide that you just showed that particularly resonated was the one that had the sort of taxonomy of themes, because we've been investing in really across all of them. I think it was a strategy group slide. So we invest in new insurance distribution concepts, novel insurance companies. We've been very active in home automation, and we invest in new sources of insight through new data feeds or new techniques for deriving insight from large data sets.
Thanks, Dan. I'll remind all of the participants that there is going to be a generous Q&A session at the end, so if you do have questions, if you wouldn't mind jotting them down and holding them for that session. And I'm going to ask Jacqueline Lesage-Krause to offer her response about the technologies that she's seeing adopted.
Thank you, Stephen. Thanks for having me. And I also wanted to take a moment to say that we are now Munich Re HSB Ventures, so we're across the whole business. Similar to Dan, I thought that the different landscape charts that you showed were very relevant, and also it's important to note that when we take a look at a particular time in terms of that data, in terms of where a lot of the money is going, that's less a sort of heat map than it is a snapshot of maturity. So we see that the comparison in the aggregators, there's more of them, there's more money going into them because they're more mature and they've been around for longer. I mean, back in 2008 when I was leading the venture group at the Hartford, and we were the only direct investment strategic corporate VC in the insurance space, most of these sectors didn't exist yet, but there were the comparison markets and the aggregators at the time. And now, of course, so many corporate VCs in the space and so many different types of companies. And similar to Dan, we're also looking across the whole landscape. And so we look at the new insurance companies, although we think about them not necessarily as distributors, but as the future of insurance and client companies, because we are a reinsurance company. There's also all the technology and services that we can hang off of our products in order to, or those of our client companies, to underwrite better and mitigate risk. And I think we've seen the market start with auto and home, but more recently we're seeing that move into the commercial space as well, around property and certainly IoT on the commercial side. And we're very active there and are actively building a portfolio on the commercial IoT side. There's also a lot of technologies that are very focused on the industry and being part of the value chain there and providing things around imagery around claims and things like that, and we're interested in that. And then there's some areas that are just more fundamental technologies and still sort of figuring out exactly what they mean to our world. And one that's been around for the last few years is sort of the whole imagery and imagery monitoring area, so drones and satellites. A lot of those companies are getting larger right now. They're not necessarily, it's not a new space, but I think that there's some fundamental technology there, and we're all trying to figure out how to bring that information in and how to use it and what it means for us. And then certainly right now, big data sort of morphing into AI and what that's going to mean for our industry as a whole. I think we see an increasing amount of activity going there. And as insurance companies, and when we look at the way that the corporate VCs have played over the past few years, I think they started off with technologies and services to hang off of products. And now as their innovation groups are getting ramped up and there's more activity going on in the ecosystem that's focused on insurance, we're moving out from those things that are sort of more obvious to these things that are more foundational technologies that we know are going to mean something to us, like AI and areas like that.
Thanks, Jackie. That's really illuminating. I appreciate it. Next, I'll ask the same question of Laura Kane from Tom Vest Ventures and see what differences she and they may be seeing.
So echoing Dan and Jacqueline, comparison sites and aggregators really have the most traction. You see them in auto and health. They've obviously sort of taken over the market in that area. One area that's been gaining a lot of traction, at least in terms of funding from VC, are these full-stack insurance companies such as Oscar, Metromile, Lemonade. So while few of the full-stack insurance companies have really reached scale and don't have very many policies issued, I think in the next coming years you're going to see significant industry adoption.
Thanks, Laura. And now I'm going to call upon Brian Hemisath and just make the point that Brian, who leads the Global Insurance Accelerator, is definitely coming at this question from a different angle and probably on a different timeline. But Brian, I'll let you explain.
Sure. Thank you. Thanks for having me. So yeah, we are not a venture capital firm or making investments at a VC level by any means. We are making very early bets in some very small companies that sometimes even border on the level of concept. And so I would argue the things that we see are maybe so bleeding edge that my comments of what we see probably don't impact the trends that are really out there from a true venture capital investment standpoint. Two observations I'll share though. The things that are getting adopted the quickest are those that can be implemented with less integration. No shocker there, but when a startup comes around and has something that can plug in much easier than a full integration, they get the traction much faster. The second point I'll make is for startups at this stage, the winning or the earning of a pilot is the biggest thing and the best thing they can do. I think it was Jacqueline mentioned the imagery and artificial intelligence. There's one example of some really cutting-edge technology where a lot of carriers aren't ready to deal with that yet or don't know what to do with it. Another example might be telematics data from even a few years ago. When you have a telematics device kicking off 50 points of data every 4 seconds, a carrier has to scratch their head and say, what are we doing with all this data? And until you have a plan on what to do with that data, it's really hard to make a long-term commitment to a startup. So point being, for us, it's less about the funds raised and more around the trends of who is securing pilots and doing business with the carriers.
Thanks, Brian. That really adds a lot of color. Let's do our second polling question now, if we may, and put that up and give everybody a chance to vote. And again, this is a 5-year horizon type question and should say on-demand or just-in-time insurance will represent what percentage of auto and property insurance premiums within 5 years from today, by 2021? More than 1%, 5%, 10%, or 50%? We'll give everybody 30 seconds and put up the response. So 44% leads with an estimate of more than 10% of premium within 5 years. That may surprise some people, and another 16% who believe it'll even be higher at over 50%. So virtually 60% of respondents are looking for significant impact with on-demand and just-in-time insurance. Very interesting. Thank you, everybody. With that, we'll move to our next question slide. And here we're going to compare strategic objectives of the corporate insurance VC funds, 3 of whom are represented here today, thank you, with VC funds in general. venture capital funds in general? There may be differences, and if there are, why? And if I may, Laura, I'd like to start with you, Laura Kane, Comvest Ventures.
Great. So just to clarify, Comvest actually isn't a corporate VC. Comvest invests the private money of Peter Thompson, whose family majority owns Thomson Reuters. So we don't need to raise capital, much like corporate VCs. But then again, we're not a strategic. We're not tied to a specific company. I would say that more than corporate VCs, we emphasize a startup traction and the potential for financial returns. We can't offer partnerships, so we're not looking for new technologies and pilots that we could potentially roll out. I would say that this may make us slightly more price sensitive to deals, just in terms of we need others to be on board, and we need to see the financial returns greater than maybe a corporate VC would say.
Thanks, Laura. Quick question back to you. Is insurance and insurance-related IoT a significant driver of your current portfolio?
So I would say our current portfolio, no, but moving forward, it's definitely one of our areas of interest. We've seen great success in online lending and a lot of parallels within insurance. So it's one of our top priority sectors that we're looking at.
Thanks so much. And now Jacqueline Lesage-Krause from Munich Re HSB, who is, in fact, a strategic corporate insurance VC. Jack, your answer?
So for the most part, I would say that we are similar to the VCs, and the things that they care about, we care about. However, there's two differences. One is, in addition to the traditional VCs, we are obviously strategic. And so that means that we are picking things based on not just what we think is going to be the biggest opportunity and the next big thing, but what's really going to be important and matter to us. And then we are able to add a very different sort of value in partnership with our portfolio companies in order to help them to create value and us to create value as well. And of course, we have some process things that go along with being a corporate, but we try to make those minimal so that we're able to play well in the space. And then on the fund side and the financing side, for us, even though we're strategic, we're also financial. So we care that that investment, each individual investment, has a good chance of returns. And the things that we use to evaluate investment are very similar to what a VC does, because the best companies make the best partners. And that's how we know what the best companies are. But when we look at our overall portfolio, that's where we think very differently from the VCs, because we're not looking for an aggregate portfolio return, and so which is difficult to do, because we are having a very specific strategic focus from an investment standpoint. And so there might be things that, that one thing that's going to generate all the returns for a traditional VC might not be in a sector that's of interest to us, and so we'll miss it. And so we have to view our portfolio differently in terms of the number of deals that we do and our sector, so we have different portfolio expectations on the financial value side.
Thanks, Jacqueline. Dan, to just put a variation on the question, are the success benchmarks for a corporate insurance VC any different in your view than they are in the general venture community?
Well, I used to get this question a lot. A few years ago, startups used to ask us, what is the purpose what's the primary purpose of what it is that you're doing? Is it financial or strategic? And I think there's a little bit of a a false dichotomy there. The purpose of strategy is to drive financial returns, and so where we're the same is a corporate VC and an institutional VC are both looking for financial returns, so that's not different. We're both focused on things that we think we can do well, or things we think have some potential, so that's not different. I guess where things are a little bit different is that we have the potential to generate financial returns through the relationship, given our scale, outside of just the asset value of the startup. And that's where I think corporate VCs, when they get started, can get it a little bit wrong, because they get maybe too interested in generating value too early from that relationship. The way I talk about it sometimes, and certainly the journey that we went through, is that a corporate VC includes the terms corporate and VC, and it's very natural for an organization to start out on the corporate side of the spectrum. So they're looking for contractual terms very early in the relationship, things like exclusivity or rights of first refusal on acquisition or special pricing. And while that comes naturally, I think every corporate VC that extends beyond the first few years really gravitates pretty hard, like Jacqueline says, to the VC side of things, where we're just looking for strategic options by getting involved in the space earlier than we otherwise would, starting operating relationships much earlier than we otherwise would, and then potentially engaging in the development of a space that could be meaningful to our industry. So back to your original question too quickly, the benchmarks that we think about, they are primarily financial because it's much easier to quantify the financial return than the strategic optionality. But we do have the things that we think about are number of operating relationships, number of introductions we've made, the depth and significance of some of those operating relationships is how we think about the strategic benefits.
Thanks so much. Really informative. Brian, if I may twist this again to accommodate sort of your activity and perspective, have you, over the course of the life of the Global Insurance Accelerator, had more success with corporate insurance VCs on uptake or with traditional institutional VCs, or has there been any marked difference?
Oh, we're too early probably to answer that question. I think a really fun debate you can get into when you pose those two sides is who is the smart money. You'll have startups talk all the time about what is the smart money, what's the strategic money, and that'd be a fun one to let both sides sit back and have this great debate over. Fred Scott certainly threw a grenade into the conversation on a webinar. Oh, it's on YouTube, but it was a month or two ago, and of course he argues that the traditional venture capitalist is the smart money, and I think there's certainly a case though made to look the other way, that the folks on the phone here are the smart money because of the strategic opportunities they provide. I think I've veered off from your original question, so let me pause and see if I either satisfied the question or if there's anything more you want me to add there.
So I guess I was just looking for a sense of any of your graduates from your incubator or your accelerator. Have any of your graduates been picked up by either side of the VC world, the corporate insurance or the traditional, or is it just too soon to tell?
Thank you. Yeah, I will put some context to this. So Drive Spotter was when our 2015 cohort. They raised $750,000 of seed capital, which was led by Grinnell Mutual Reinsurance Company, which does not have a VC arm, but certainly has plenty of capital, and decided to invest for strategic reasons in that startup. We have another announcement coming out in about 30 days of another significant investment into one of our portfolio companies, once again led by a non-traditional capital approach, but certainly related to the insurance industry. One tiny rant I'll put in, there is a gap that exists right now for companies seeking the early stage seed capital. So the people that will write $50,000 to $100,000 checks, that's a hard spot to hit. I think most of the people on the phone here will tell you they look to write much bigger checks. And so for a startup that is through our program now has to survive that long sales cycle just to survive, they need to pick up some pilots, they need to pick up some small amounts of capital to not get too diluted. There's not a lot of angel investors that understand insurance, and there are not enough accredited insurance executives, former or current, that truly do angel investing. So it creates this interesting gap where finding the people that write the $50,000 and $100,000 checks, maybe to do a $500,000 seed round, those groups are really hard for me to find, and I've only got a couple of them in my Rolodex as it currently stands. So that's a need, I think, for the market in order to support the innovators in the industry.
Thanks, Brian. Don't be too surprised if you don't hear from some of our 750 attendees today.
Bring it on.
Let's put up our third polling question, if we may. And again, this is going to be a 5-year horizon question, and it is about peer-to-peer insurance and whether that will represent what percentage of all property and casualty insurance premium by 2021. And again, the same percentages: 1, 5, 10, or more than 50. As soon as we have enough responses, we'll present the answer and move on. A little less conservative on peer-to-peer, so looks like almost 30% think it'll be under 1%, but some 65% think it'll be between 5 and 10% or above 5 and 10%, and 7% even believe it to be higher than 50% of all premium. Again, at least speaking for myself, a surprising result from a good survey. Thank you. With that, we'll move to our next panel question, which is about the attributes of early-stage Insurtech businesses that stick, that get traction. What makes startups and innovative Insurtech business investment worthy? And if I may, I'll start with Jacqueline on this one.
You know what? We haven't had enough exits to know for sure what that is. However, I would say when we are looking at it, it's honestly the same thing we look at in other sectors, especially when they're early. Management team, their technology, their vision. We like to see some understanding of insurance. If they're going to be an insurance, one of the full stack insurance companies, then we like to see some understanding of insurance, but we don't need to see insurance founders. And on the side of things that aren't full stack insurance companies, but technology and services that are going to be relevant to us, then we like to see really just the same thing as we do in any other evaluating in an early stage company. But we like to see how focused they are on the insurance vertical, and at that particular stage in their development and our development, are we a good fit, right? Because some corporate VCs might say, oh, we only do a certain stage, and that might be because of certain financial appetite reasons, or it might be a view of risk or a view of strategic value, as Dan highlighted about how much value they're trying to get early on. I think our view is it's appropriate to kind of right-size the relationship, and certain startups will be at a certain stage in how well thought out they are about how they're approaching the insurance industry, and we might have certain things that we're working on where we're at different stages in terms of where we are from a learning to a operationalizing and commercializing standpoint. And so we can handle the entire range, but the companies, we need to find good matches for where we are and where they are to find the value that's going to come beyond the financial value.
Thanks, Jacqueline. Dan, what to you and your team represent businesses early stage or startups that are investment worthy? What are the criteria that you like to apply?
Sure. Like Jacqueline said, there's the general set of criteria that are the same for everyone. So what's the context for the opportunity? What are the specifics around this concept? What's the feeling on the team? What traction do they have for the price that they're expecting? But if I could, I'll speak a little bit more about home automation companies where we've been particularly deep. We've had some successes. We're in a company called Ring, which makes a doorbell and has been doing very well. And we've had some real struggles. So for us, we've evolved a bit of our selection screening for home automation companies. And the things we think about in those partnership opportunities, it has to, the home automation device, in our view, has to have some primary purpose other than insurance risk mitigation. It has to provide some customer value beyond the relationship with us. And I think that's sort of an obvious one, but one that we can overlook in our zeal to mitigate water risk or fire risk. We do think it has to have some secondary nexus to the insurance industry for us to be a value-added partner. So we think about the data, data exhaust that some of these systems create, or direct risk mitigation opportunities. We think that home automation solutions have to be design-oriented with a sort of mass luxury feel. And one of the reasons why is if you think back to the first time you saw a Nest, a thermostat, it just looked cool. It had sort of an aspirational feel to it. It may be the same with Alexa devices that are talking to you, and I think Ring has the same feel as well. It has to be something that's visible. It can't really be too tucked away behind the scenes. I think there's a sort of word of mouth or a viral component to some of these things that have gone well. It has to be self-installed, and we think that the price point matters a lot. So we see a sweet spot in the $100 to $200 range, and we do see some resistance above 200, with some obvious exceptions. But we've been in a couple of companies that are trying to sell water sensors for, say, $299, and we just haven't seen the pickup at that price point versus something that's under 200, and in some cases even under $100.
Thanks. It's funny, it makes sense as you say it, but it's probably a hard learnings to come by. Brian, I know you're at the front end of the process, earlier stage, smaller scale, et cetera, but how do you assess the qualifications for applicants to your accelerator? Because that could be sort of the front end of this question.
Sure. And one correction, I think earlier I either said Fred Smith, who is Fred Smith or Fred Scott, and I meant Fred Wilson when I referenced one of the venture capitalists with a quote. Anyway, to answer your question, we are very early, and so often there's not even much technology to play with. Certainly there's very little revenue, if any, and so we're looking at a product, a concept, and the team. And the team is the core. And there's two things I look for in a founder or a founding team, and the first is persistence. Two things that happen to startups at the early stages: they get told no a lot, and the second thing is that they are faced with what I call the floodplain of opportunity. And we have something here called mentor whiplash, and you'll hear a mentor tell you, oh, you should be chasing after this or do this, and you'll have a mentor 5 minutes later tell you the exact opposite, and you have to decide what you're going to do. So the persistence to carry through the constant no's, doors closing, as well as the opportunities/distractions. And the other attribute that we look for is the ability to listen. And it's easy for a startup to fall so in love with their product and their baby that they don't know how to shut their mouth and just listen to what the customer is telling them. And that listening is what leads to better product development, better team building, which then leads into all sorts of things such as raising money, hopefully with the folks on the phone today with us.
Very interesting. So the words entrepreneur and ability to listen are not necessarily a contradiction in terms?
No, it's usually a telling sign of success as to how well they can just sit back and listen.
Very good, thanks. Laura, is there anything you'd like to add to this one?
So I think team is extremely important, and then you need to strike a balance between having industry experience and then being able to think outside the box and break the boundaries of the status quo may impose. So I think also a team that has a business leader who maybe has a lot of experience within insurance and a CTO who knows how to build the product in-house is extremely important and also valuable. I think beyond that, having a solid business model, so a solid plan on how you will generate revenue, manage risk, and deal with fraud are three areas that within insurance I think are extremely important and relevant when evaluating startups. Also, another thing that we think of when we look at companies is the total capital and the time horizon to break even or IPO. So VCs need to return their money. It can't be a 30-year time span. And so looking at exits, looking at how quickly a business will scale is extremely important.
Wonderful. Thank you so much. With that, we're going to ask our fourth and final live polling question. And again, same 5-year horizon on the question. And it is the infamous fully autonomous or self-driving automobile question. What percentage of the total fleet, total car park in the U.S. Will be fully autonomous and self-driving within 5 years by 2021. More than these percentages, please vote. Thank you. Well, everybody thinks it'll certainly exceed 1%. Some even believe higher than that. And I think our self-driving automobile participants are going to be encouraged by the result of this poll. Thank you all. That leads us to our next and final question before Q&A of our panel. And this is about the future of technology and insurance. One of the sort of more difficult questions to ask, but what all these folks are particularly good at doing. What does the future insurance company look like, and how advanced will technology requirements be in order to sustain the business? Dan, I'll ask you to lead off.
Sure. Well, you know, the way I would think about this is there's been a history, which I think will continue, of trying to upgrade and always modernize how insurance companies engage with policyholders. And while right now there feels like there's a large gap between how customer expectations have evolved in a digital context versus what insurance companies have been able to deliver, I think that insurance companies, whether it's the incumbents or new ones, will make great strides in how those engagements happen in the future, both in terms of frequency and the positivity of how we connect with policyholders. And the other thing that I think is, it's also not new, but I think we'll see ongoing progress is how sophisticated are insurance companies in assessing risk. And digital inputs and analytic techniques will continue to improve, but then there'll also be new types of risks, and companies that are nimble and capable in assessing and pricing those risks will be the ones that sustain relevance.
Thanks so much. Appreciate that, and I'm going to ask Jacqueline to add her response to the question.
I think there's three big impacts that are somewhat related, and one is, you know, it all kind of starts with just a lot closer interaction with end customers, and thus a lot of data. And insurance companies are going to be even more than they are now, data companies, and very forward-thinking data companies. And that's going to lead to, over time, we're going to see our overall premiums, at least for current existing products, going down, and probably our services aspect going up. The third thing is we'll see new revenue opportunities. There's going to be new risks and new insurance and other types of financial products that end up becoming opportunities beyond today's common insurance products. And then there's a separate thing that's going on, although it's somewhat related, which is I think we're starting to see, and we'll see how it plays out, this is sort of nascent, we're starting to see the unbundling of traditional insurance products. I remember in a previous life when I was working with a consumer lines carrier, and we'd be looking at new product opportunities. And really, they either had to slot into home or auto and add on to those products, or it really wasn't going to be something that was going to go out and go to market. And now we're seeing a range of different companies and opportunities creating different durations, taking specific risks and extracting them out and just covering those and giving people more piecemeal ways of managing their risks. And by people, I mean individuals as well as commercial customers. So the unbundling of traditional insurance products and the changes in their structure, I think, is something that's upon us. And you know, we can see that, for example, with companies like Trove and others.
Thanks, Jacqueline. Laura, from where you sit, what do you see as the critical technology requirements of future insurance business operations?
I think the ability to utilize data, real-time data, is going to become extremely important and help move functionality online. I think you're going to start seeing this with application processes moving online and specialized services such as loss prevention, where they could suggest locations to park your car to avoid vandalism or avoid weather damage start to be introduced. I think eventually you're going to see very specialized insurance products be rolled out. So for your iPhone, an insurance company or carrier could look at how often you utilize your phone, how often you drop your phone, where you are walking through every day, whether you go through high crime areas, and use sort of the personal usage and behavior to specialize your insurance product and eventually give you closer to actuarially fair insurance premiums.
Good. Thank you so much. Brian, again, from your perspective, earlier stage, what do you see as some of the key technology requirements that you'd like to help companies bring to market for carriers in the future around IoT?
A broad answer to this, for those not familiar, I am not from the industry. I was brought in specifically to be that person that was brought in that didn't look at something and say, oh, we tried that 4 years ago, that will never work. They wanted kind of a fresh perspective, a bit of naivete, if you will. And there's a well-known venture capitalist named Mark Andreessen. He put out a quote in an article a few years ago, and the main quote was that software is eating the world. And I couldn't agree more with that sentiment. It's the idea that technology-enabled businesses will continue to thrive and grow and probably dominate other markets. And so when you think about that quote, software eating the world, what we're really talking about is technology. And to me, there's two tracks. There's technology that does things that humans do today, and that falls into that machine learning, artificial intelligence camp. And then there's software that enables people to do things that people currently do for them. So this is the self-service model, possibly distribution. I think agents and brokers, if they're not paying attention to what's going on in the technology space, they need to be, because there's a lot of change coming, a lot of things that people are going to be able to do for themselves that currently other people do for them, and the software is what changes that. The other, I hate to be a downer here, but the other twist to this, of course, that I've learned being involved with this industry now for a couple of years is that compliance and regulation makes a lot of decisions and a lot of limitations to what is possible. And so the other thing to keep in mind in all of this is that we need to keep our regulators, lawmakers, current on what's going on. So the Iowa Insurance Commissioner is a mentor at our accelerator. He's here seeing exactly what's being worked on. He's a thought leader anyway, but we need those people that in those positions to be watching what's coming upstream at the early stages, so they can start to make policies and at least have intelligent conversations about data privacy, Internet of Things, all the stuff that's going to impact a data-driven company, which insurance companies are data-driven companies. You know, how they view that data, how they make laws and regulations around it. So there's my view.
Thank you, Brian, so much. We have approximately 12 minutes left and about 12,000 questions here. So without wasting any time, we're going to move to the slide on Q&A, and I'm going to field these questions to our panelists in no particular order, and please don't be offended if I can't ask this question of each and every one of you. There's so many here, and they're all terrific. I'm going to start with the first one we received. Should insurance incumbents be afraid of startups with much lower cash reserves that are able to avoid ever paying out by using sensors and telematics? Anybody is welcome to either raise their hand for that question, or I'll just ask it arbitrarily of Dan.
So I agree with the premise that there's a growth opportunity here. There were some embedded, you know, should insurance companies be afraid of it, and would we expect that these new companies that focus on IoT deployments won't end up paying claims? That I would dispute a little bit of the premise of that, but you know, certainly it's been a very active part of our investment thesis is to get involved with companies that are reducing risk and providing some you know, frequent and positive customer experience in the home.
Yeah, by the way, trying to read the mind of the questioner, which I can't really do, I don't think they were talking about avoiding paying claims as much as avoiding claims themselves through sensors and telematics.
Yeah, no, you know, BCG and Morgan Stanley put out a report a couple of years ago that we still quote around the loss mitigation opportunity for IoT plus insurance. And I think KPMG just put out an estimate of the reduction in auto premium associated with reduced frequency through autonomous deployments.
Great. If any of the panelists want to add to the response, please do. And if not, I'll move to the next question. Next question is, and I think I'll only ask this of the non-corporate VCs, so as not to put anybody in a difficult position, but who are the most active corporate VCs in the Insurtech space, and are there specific segments that they're interested in more than others? I think we answered some of this question in the webinar, but Laura, let me start by asking you your view of who are the most active corporate VCs in Insurtech.
So I actually don't have great data on this. I wouldn't be able to give a completely accurate view since my view is going to be sort of skewed towards the companies that I've had interactions with. But I think AXA, USAA, Mass Mutual, Intact Financial, American Family Ventures, AIG, New York Life have all been active in Insurtech.
Thanks, Laura. Brian, do you have anything to offer or add to the question?
That's a great list. The only two I'd add that I've networked with is Liberty Mutual, is making investments in Transamerica as well.
Thanks so much.
I've heard something about Munich Re.
I don't know, Jackie could tell us, but I think their name does appear frequently, and we know what their portfolio, some of their portfolio looks like.
Yeah,
by the way,
forget about our panelists.
No, well, I didn't want to put anybody on the spot. Everyone's obliged to support their own organization. But I did want to make it clear to everybody on the call that all of the great panelists today are all also presenting at the Insurance Summit event. So let's ask this question. Isn't it early to bet on some of these peer-to-peer companies and new insurer models, such as Oscar, which is failing rather publicly right now, and Lemonade, which hasn't even launched yet, but are already falling under fire by regulators for a potentially difficult business model? So there's a question about, is it too early to bet on peer-to-peer? Anybody care to offer a response? Maybe
Brian,
go ahead.
I'll throw out, yeah, we see peer-to-peer applicants come to our accelerator quite often, and I think even before you ask that question that was asked, is what is peer-to-peer? What does that mean? That's, at some point, if you look at just a traditional insurance company, it is peer-to-peer. People pooling their money together for protection, and then what's built into that insurance company is the claims process, the underwriting, all the management, all the other pieces that make it an insurance company. So again, from an outsider's, a new person to this industry, what truly is peer-to-peer starts to fall apart when you look at, so you threw out some names of startups, so we haven't seen what Lemonade is yet. But if they come out and they put the claims processing back to the hands of the consumer, so you got to ask yourself, okay, I just saved 80% on my insurance because it's peer-to-peer, but by the way, once a week I need to look at 50 claims of my peers to decide if I'm going to agree to cover it or not. I don't know if that's what Lemonade's doing, but point being, we see applicants that come to us with these types of ideas, and we kind of scratch our head and say, well, is this model viable? Because you're relying on the crowd or the peers to do a lot of work that currently you're paying your insurance company to do. So hopefully that makes some sense, or at least provokes some additional thought around the peer-to-peer space.
Yeah, it is actually valuable feedback. Thank you. Anybody else want to offer anything on peer-to-peer before we go to what we may have time for just one more good question here?
Yeah, I would say that peer-to-peer really sort of models reciprocal insurance, and that it's not a new concept. I would say that also the issues that a lot of the peer-to-peer insurance startups are facing are not necessarily regulatory yet. I think there's a lot of issues with underwriting and adverse selection in terms of who's attracted to these types of products that are more pressing than the regulation. Because until you reach a certain scale, I don't think that regulators are too harsh on your business model.
Thank you. If there's no other add-ons for peer-to-peer, I'm going to ask, I think, what is our final question, which is, what is the definition of a full-stack insurer? Metromile, Oscar, Lemonade were given as examples earlier, but do they underwrite their own products? And can you clarify what qualifies as a full-stack insurer? Jacqueline, if I may, I think you made some comment on this subject initially, so I'll ask you to start.
Yeah, so I think there's not a common definition about what it means. I think that the most broad definition is when people mean that they're doing all of it themselves, oftentimes including building their IP, as well as you know, doing the claims, owning the customer interface, doing the underwriting, and even as in the case of Oscar, you know, being an actual carrier. I think what we're seeing more typically and still often being called full stack is the MGA model, which is a lot of that, minus having the balance sheet requirements and actually, you know, being an insurance carrier. I think we're often seeing that as being considered a full stack company as well. And we certainly like seeing companies that are being broad in their focus in terms of the customer relationship and the data and the underwriting. Those are some of the things that we get particularly excited about in the pure Insurtech space, and and we aren't as interested in those that are actually carriers at this point.
Okay, as a follow-up, is internal underwriting, in your view, a critical component of the definition of a full-stack insurer?
I think that if we're going to talk about that as a definition, I think we would assume that, yes, they are going to be doing some of the underwriting as well. How we feel about that differs in different situations, but for a full stack definition, I think it includes that they're doing the underwriting. Absolutely.
Okay, thanks. Anybody else want to add anything before we hand it back to Marcia? I need to thank all of our panelists and all the attendees for making this an outstanding session. Thanks for your insight, folks, and we look forward to the conference, to the Insurance IoT USA Summit in Chicago, and seeing you all there. Marcia, over to you.
Yeah, I just want to say also a personal thank you to Dan, Jacqueline, Brian, and Laura. Thank you so much for taking part in this today. It's fantastic to have had you involved. And Stephen, thank you so much. I know it's taken some time for you to get everything together and to prepare for this. We really appreciate all of your continued support. We're really looking forward to hopefully seeing a lot of you at the Insurance IoT event in Chicago. I know there's 700 of you, or more than 700 of you here on the line. We're expecting about 300 people at the Insurance IoT event. We already have about 150 signed up. And really what we're trying to make this is a place where Insurtech and the insurance industry can really come together and discuss a lot of these changes, a lot of these questions that you've been submitting today. Obviously, we'll be able to have more time to cover all of that. So please take a look on our events website. I've provided the link there. There's the discount code for you to save $200 if you sign up. And I'm going to follow up with an email so that you all have that information. So thank you again. It was great to have everyone involved.
Thanks, everybody, again. Have a wonderful day.
Thank you.
Bye.